Have you ever heard people talk about index funds, mutual funds, or ETFs, and thought, what are these things? And why do they sound so complicated? Well, don't worry, today we're going to break them all down. In a way that's super simple, super practical, and totally beginner-friendly. In this video, you'll learn what a fund actually is, the types of funds, how they are managed, the risks and fees involved, and how to figure out which one might be right for you. So grab a drink, get comfortable, and let's make investing make sense. Section 1. What is a fund? Imagine you want to invest in big companies like Apple, Google, or Coca-Cola. But you don't have a lot of money to buy each stock individually. Plus, how would you even know which ones to choose? Well, that's where a fund comes in. A fund is like a basket of investments. You and other investors pool your money together. And that big pool is used to buy a mix of stocks, bonds, or other assets. So instead of putting all your money into one company, a fund spreads it across many, which helps reduce your risk. Think of it like a fruit salad. Instead of eating just one fruit, you get a mix. That way, if one fruit is a bit sour, the others still make the salad tasty. Section 2. Types of funds. Now let's talk about the three main types of funds you'll hear about. Mutual funds, index funds, and ETFs. 1. Mutual funds. A mutual fund is professionally managed. That means there's an expert, a fund manager, whose job is to pick and choose which investments go into the fund. They analyze data, read reports, and make decisions about what to buy or sell, all with the goal of getting you the best return. For example, a mutual fund might include tech stocks, healthcare companies, and even some government bonds, all carefully selected by the manager. But here's the catch, you pay them for their time. More on that in a bit. Let's break it down with a practical example. Ever wonder what a mutual fund manager actually does? You invest $100,000 into a mutual fund. Now meet Mrs. John, she's a professional fund manager. Her job is to grow your money. She studies the markets, reads company reports, and decides what to buy. Maybe she picks Apple, Tesla, and even government bonds. So your money is spread out, across tech, innovation, and bonds, all carefully selected by her. Her goal? To get you the best possible return, without you doing all the hard work. But here's the catch, you pay her for her time and expertise, usually about 1% a year. So if your investment grows to $110,000, she might take $1,000 as her fee. Not too bad at first, but over time, those fees add up. That's the trade-off, expert help in exchange for a fee. You will see how those fees compare with other options like index funds and ETFs. Invest smart. Know what you're paying for. 2. Index funds. An index fund is a type of mutual fund, but way simpler. Instead of trying to beat the market, it just tries to match the market. Let's say you want to invest in the US stock market, but you don't want to spend time picking individual stocks. Instead of choosing companies one by one, you buy an S&P 500 index fund. Here's what happens. The index fund automatically invests in the top 500 companies in the US, just like the actual S&P 500 index. So, your money is spread across companies like Apple, Amazon, Microsoft, and 497 others. If Apple makes up 6% of the S&P 500, then 6% of your money goes into Apple, and so on for every other company. No human picking, just automatic matching. There's no fund manager actively choosing stocks. The fund simply copies the market, like a mirror. And that's why fees are super low, sometimes as little as 0.03% per year, because there's no one actively managing your money. 3. ETFs, exchange-traded funds. Now here's the cool one, ETFs, or exchange-traded funds. An ETF is very similar to an index fund. Practical example, what makes ETFs different? Let's say you want to invest in the S&P 500, the top 500 companies in the US. You have two choices. Option 1. Index mutual fund. You buy into an S&P 500 mutual fund. It tracks the same 500 companies, like Apple, Amazon, and Microsoft. But you can only buy or sell at the end of the trading day, no matter what time you place your order. For example, if you submit your order at 10 a.m., it won't be processed until the market closes, usually 4 p.m. Option 2. S&P 500 ETF. This also tracks the same 500 companies. But it's an ETF, traded on the stock exchange like a regular stock. You can buy or sell at any time during market hours, and the price updates in real time. For example, at 10:15 a.m., the ETF is $50 per unit, you buy it right then. At 2:30 p.m., it rises to $52, and you decide to sell. The key point. An ETF is like an index fund, but with more flexibility because you can trade it throughout the day, just like you would with shares of a company. Section 3. How funds are managed. There are two main styles. 1. Actively managed funds. This is where a professional manager actively picks stocks and tries to beat the market. This is common with mutual funds. It sounds great, but here's the truth. Even the experts don't always win. And because it takes time and research, these funds come with higher fees. 2. Passively managed funds. This is the style used by index funds and most ETFs. No one is trying to beat the market, they just copy it. No fancy analysis. No daily decisions. Just low-cost, consistent exposure to the whole market. And that simplicity often outperforms actively managed funds over the long term. Section 4. Risks and fees. Alright, let's talk money, because every fund has fees, and over time, those small numbers can cost you big. Imagine you invest $10,000 for 20 years. And let's say your investment grows 8% every year. Now let's compare the same investment in 3 different funds with different fees. Mutual fund, 1% annual fee. Index fund, 0.1%. ETF, just 0.03%. After 20 years, the mutual fund grows to about $38,000. The index fund grows to around $45,600. And the ETF grows to about $46,200. They all earn the same return, 8%, but the fees made a big difference. You lost $8,000 or more just because of higher fees. That's why smart investors look beyond the returns. They check the fees too. So next time you choose a fund, don't ignore the small print. Because over time, small fees equal big money lost. Invest smart. Pay less. Grow more. All investing carries risk. The value of your fund can go up or down, depending on the market. But here's the good news. Because funds are diversified, spread across many investments, they're usually safer than betting all your money on a single stock. Still, nothing is guaranteed. Even diversified funds can lose value during a market downturn. Section 5. Who are these funds for? So who should invest in these funds? Mutual funds might be for you, if you want a pro to handle everything. You don't mind paying a bit more in fees. You're okay with less flexibility. Index funds are great, if you want low fees. You're investing for the long term. You believe in slow and steady wins the race. ETFs are ideal, if you want flexibility. You're comfortable buying and selling like stocks. You're looking for a mix of simplicity and control. Honestly, if you're just starting out and want to invest without the stress, index funds and ETFs are both amazing places to begin. You don't need to be rich. You don't need to be an expert. You just need to start. Section 6. Quick summary. A fund is a basket of investments. Mutual funds are actively managed and more expensive. Index funds are low cost and follow the market. ETFs are flexible, low cost, and traded like stocks. Each has different risks, fees, and styles of management. And they're all tools to help you grow your money over time. If this helped clear things up, go ahead and hit that like button, and don't forget to subscribe for more easy-to-understand money tips. Drop a comment if you have any questions or if there's another investing topic you want me to explain. Thanks so much for watching, and remember, you don't need to be rich to start investing. You just need to start.